It's time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. Today, we're joined once again by Rob Tetrault, Senior Portfolio Manager at Canaccord Genuity. Rob, you've got some thoughts, some very interesting thoughts on how investors should think about market dips, and particularly this idea of legging in, of adding to positions during periods of market weakness.
Yeah, I think the key, Paul, with respect to your asset allocation, first things first, you should look at your asset allocation. So if your number should be 40 or 50 or 60, or maybe it's 100% of your net worth or liquid net worth invested in equities, then, okay, how do we manage that portion of equities? It's not the time, in my view, it's never the time when markets are freaking out to be making significant changes to your asset allocation on the negative side. So you should not be saying, you know what, I'm going to go down to 20% equities here because I'm freaking out. And you also shouldn't be doing the opposite. You shouldn't be loading up on equities, because the reason we have asset allocation is for us to sleep at night. We need to be able to sleep at night. We need to be able to control the volatility of the market. And how you do that? You do it through back testing of hundreds of years of data. And that back testing allows you to know roughly what your movement is going to be. So you asked me, Paul, about legging in. So a neat way to do this is if you have cash on the sideline, you do it in one of two ways. You either invest as the market moves down in increments, so X percentage. Maybe you put 5% every time the market moves down 3%, and that'll get you to kind of 40% invested. Or you leg in over time. So if time is 6 months or 9 months or 12 months, whatever that period may be, then you leg that into the market so that you're doing one of two things. If the market doesn't move negatively further than it has up to now, you're still going to be buying all the way down. So that way you're protected, you get to buy the dip, and we all know it's almost impossible to pick the actual bottom, right, Paul?
We do indeed. The idea of legging in during market declines assumes you've got some cash. What are your views on maintaining a portion of your portfolio in cash so that when markets turn south, you're able to buy?
So it's not something we believe in. We believe largely in being fully invested. However, you might be in a situation where markets move negatively, that you have maybe a chunk of your portfolio that's been not exposed to markets. Maybe it's commodities, maybe it's private real estate, maybe it's fixed income that's supported well, maybe it's actual GICs. And if you have the ability to convert some of that into cash, you might want to take a position, because what's happened now is your 60% equities might only be 50% equities now. So you might be doing just prudent rebalancing. And with prudent rebalancing, you're legging in a much shorter period of time. You're effectively doing it kind of in one shot, right? So you'd be trimming asset classes that have kept their value, infrastructure, private real estate, commodities, and you're moving that towards equities that have corrected. And a short leg in like that on a rebalance can be done almost instantaneous, or perhaps in 2 moves.
Okay, why don't you tell us what some of the sectors or indeed stocks are that you're legging into on behalf of clients during this market pullback?
Okay, so you're going to be looking at sectors that you're either underweight in. What you don't want to be doing is making massive plays on one specific thing with all of your cash. It's not something we believe in. It's a great way to get rich through concentration, but it's not a great way to stay rich through diversification. So we would look at positions that are now undervalued, that have fallen more than others, and that are presenting opportunities. Quality names that have fallen a ton more than they should, that are still profitable. You want to stay away from speculative stocks in these types of situations, and you're adding proportionately across those. You might want to take 1 or 2 plays. You could make like a reopening play and buy 1 or 2 airlines, or a casino and an airline, or something like that. But overall, what we believe in is if you're doing the legging in, you're doing it across the different sectors, across the different names, and you're picking the quality names. You're not speculating.